Portfolio Builder members, welcome to our Thursday webinar class. Quick shout out to some of the folks out there. We've got Dean, D Invest, Fred Cook, Jerry Simone, Mike, New Mexico Art, RD McDermott, S Moon 64, TG Profit, Wanza, and people keep coming in, so welcome. We will do a presentation on our various portfolios to start off, and then look at the most recent news, some of which you guys may have seen in our whale update today. And then from there, we'll open up for Q&A. So today is a FOMO day, fear of missing out. Probably the biggest downside to our product is missing out on big gains. So this is a period where the SPY ETF flew very quickly up back to the 288 level. We sold the 280 covered call. So we have a baked into the cake profit of $69 per contract, which annualized is a huge return, well over 35%. And that's what we're trying to do, is pull in around $50 to $100 of credit 3 times a week, 52 weeks a year. But this is a opportunity where folks could have made several $100 per block of 100 shares of SPY they owned in a very short period of time. So let's take a look at that current trade and what the most likely outcome is. So we sold this for $467 when the SPY, I'd have to go back to that screenshot, which I'll pull up. Few more people coming in. Welcome. Okay, so let's take a look. From Monday through Wednesday, we generated a $1,802 profit, and that was around a $90 profit per contract. The higher the volatility goes, the bigger the potential profit. So we sold the 280 strike against our 100 shares of SPY, expiring tomorrow for a credit of $467, but that was offset by a guaranteed loss on the underlying of $4. So we had $69 of profit approximately baked into the cake, and that's what's going to happen most likely. You'll either own your shares and cover the covered call, generating the profit on the underlying, or you'll be assigned, you'll be sitting on cash, and you'll have that $69 to $67 profit per contract. So if we take a look at the trade for tomorrow, just to give everybody a heads up of what to expect. If you're assigned and in cash, good for you, nothing to worry about. You'll just buy the SPY ETF back, and we'll do this same repetitive process again. If you're not assigned, an assignment always happens overnight, so we don't know until the next day. Then you'll simply want to close it. So here's how we would close that: buy to close. And so this has gone up by a value of, let me pull this, oops, that's the wrong one. So while the SPY ETF has gone up in value by $3.56, our covered call has gone up in cost by about $3.80. And so once tomorrow happens, the time premium will have evaporated in this option contract. And I'll cover this tomorrow, but we're all going to make around $67 per contract on this, whether you're assigned or just hold on to the SPY. So this is a situation we put ourselves in. If the market goes higher, we can't lose. If the market goes flat, we're fine. And as long as we trade above 280 between today and tomorrow, we're going to generate around the same return. What's the expected trade going to look like tomorrow? It'll most likely be another covered call that's in the money. And let's take a look at the VIX. The VIX is collapsing pretty quickly right now. And so this is a signal that a lot of money is pushing that VIX down. And pushing the market higher. If we look at the option market, we can see there's a huge bet piling up right here at the 290 strike with 125,000 shares outstanding for tomorrow. So I would expect the market to climb higher. And now we're seeing that the balance of risk is now going back to the call option side. So most likely this will continue till the VIX gets crushed back down to those low levels. And right now there's been a little bit of relief in the trade war. They delayed the war with Europe on auto tariffs, so that was a big sign of relief. And now they're looking forward to this G20 meeting in about 3 weeks. But we'll take a look at what's happening under the surface and why things don't look so rosy for the stock market despite this very bullish run-up today in the SPY. Which is just incredible. Over the last 2 days, we've traveled $7 higher on the SPY ETF. So come tomorrow, we'll look at what strike makes the most sense to cover over the weekend, but it will most likely be just $1 or $2 under the trading price. We'll have around a $50 to $75 baked into the cake profit if the market does travel higher, and still have some downside protection. Today was our first release of the whale portfolio. This is for much larger positions. Let me take a look at that. So everybody's familiar with our basic program. This is taking advantage of the option market on the SPY ETF. SPY ETF is the highest traded security in the world, averaging $16 billion a day in trading volume, but it also has the most active option market, which is where we try to generate our profit. We're not going to hope the SPY ETF goes up forever. Rather, we can count on there being gamblers who want to bet on short-term moves in the SPY. And so that's what this product's all about. It's been slowly and consistently generating profits. In big up days, it does make less than everyone else, but in big down days, it usually doesn't even get touched. In fact, we've been generating larger profits than normal on the down moves. So next trade alert for this will come out at noon Eastern tomorrow. We've also added in the cryptocurrency portfolio. Now our company did get started way back in 2017 creating an index software for cryptocurrencies, and this was designed to mimic the exact same way the SPY ETF works. The problem was it was very complex. The security issues for most folks following it were way beyond their means of being able to follow the instructions. So while we do have quite a large user base who have been following this since way back in 2017, we have created a more simplified version that will be given out to everybody on the basic program tomorrow, alongside some new tutorials. And we've really simplified it. These are all coins that can be held at the Robinhood app, which is nice because number one, let me pull up their website. The Robinhood app, not only does it cover all the expenses for trading equities in terms of commission costs, it also covers all costs for options trading, including assignment, completely free, and they federally insure $500,000. So as long as you're not trying to hoard Bitcoin and hide it from the government and go cash it out at ATM machines and try to avoid taxes, this is a much smarter way to store your cryptocurrency portfolio as well as the rest of your portfolio, because they are the fastest growing brokerage in the world. They're valued at $5 billion, and a bunch of private equity in San Fran is covering all your costs. So you can have everything that has to do with our product very hands-free from one spot if you just use the Robinhood app, and you'll save a lot on commissions. Now, currently they don't have a huge basket of cryptocurrencies that are worth trading. So right now this one is only trading Bitcoin, Ethereum, Litecoin, and Bitcoin Cash. Now this is the same starting date for the rest of our portfolios, 12/12/2018. And so In a little bit, we'll look at some of the news related to the trade war and how that relates to cryptocurrencies, and when I think we should be taking profits out of the cryptocurrency portfolio, moving to cash, and then slowly getting ready to short Bitcoin back down. So we'll talk about the big moves and how to anticipate a potential top coming up for crypto. If we go to our Diamond program, this is the same thing as our basic product, except that we're looking at what the SPY ETF actually purchases for you. And so we have removed the most expensive companies that the average investor in our program can't afford, which would be companies like Google and Amazon, which combined to own 100 shares would cost around $300,000. Now this portfolio can be built for $150,000, and it has done about twice the return as our basic program. The reason why is the individual securities have a greater level of volatility, so the call option market is more expensive, which means we can generate a higher return by owning these individual companies versus owning the SPY. And so if we look at the most recent trades on this, it's sitting pretty. The previous week we had gained a couple $100 week over week, nothing big. We had a very defensive trade the prior 2 weeks and had actually saved our ass, to be frank, in the last week, because we got that huge unexpected sell-off with the Trump tariff threat. And so this week we were a little more bullish and wrote our strikes slightly closer to the trading price. So there's a nice baked into the cake profit on all of these positions. And so all you need to know if you're following this program is, as long as, let me zoom in so everybody can see this easy. If you are following the Diamond program, all you need to know is, as long as we trade above these strikes, we are achieving our maximum profit. So right now we have a big cushion on all of these, and all of these portfolios are performing very well. Now again, this is the time where you have that feeling of missing out, FOMO. Don't worry about it. We make the consistent return week after week with protection to the downside. And as we get into some of the news flow, you'll see why there's a great reason to be concerned about the health of the market and how long this can last. So no big hedge in this portfolio. The basic portfolio does have a hedge beyond the covered call, which is right here. And that's the 264 strike expiring July 19th. The price on this has definitely gone down, so we still recommend you own one of these put options, which represents a little less than 1% of your total portfolio per 100 SPYs you own. Now going over to the whale portfolio, this is for a much more patient investor. While the basic product and the Diamond product is designed to bring in investors, immediately deliver results, generate income right this second, no waiting around, no hoping this or that happens. The whale product is a different class of investor. First of all, you're going to want to have a 7-figure portfolio because when we do rotate into these stocks to keep a balanced portfolio, you're going to need a substantial amount of capital to match what you're going to invest to buy 100 shares of Amazon and 100 shares of Google. So we still want to replicate the asset allocation of the SPY ETF to maintain a diversified and balanced portfolio. And so to do that, while you have such amount of capital in Amazon and Google, will require around the neighborhood of $1 million. Now, right now, it's not touching those with a 10-foot stick. It's been riding the TLT. So there's a boring return holding bonds, but if you buy the TLT and then sell the covered call, it's a much more interesting way to generate a return. Now the covered call income on the TLT is far less than the SPY, and that's because there's much less volatility in the underlying asset. But when you're selling covered calls, that's exactly what you want, a very boring, stable product. And so right now, the bond market is betting that the Fed will drop the rate slightly, And so there's a ton of money to be made letting people bet just how high the TLT will go. Lower rates, higher TLT. So this is actually taking some losses on the covered call side because the option market has been correct. The TLT continues to climb, and so the covered call has generated returns in most of these trades, but there have been instances where the TLT flew up higher. And again, when we're doing the covered call strategy, we don't mind when the asset goes higher. We're really only worried about it going lower. And so our basic outlook on this is, while there is a trade dispute, this will be bullish for US bonds. And until that is resolved or escalated, this period of tension will continue to support the TLT. So this one just does a trade alert every Thursday, and will likely continue to do so for several more months. Now, the hope for this portfolio is that we will get a stock crash and a VIX that spikes above 40, in which case it would rotate out of the TLT and start the in-the-money covered call strategy on these big hitters. So we've got quite a while to be patient and wait for that opportunity. And in the meanwhile, there's plenty of liquidity for people to buy the TLT and then to write the covered call. Now, what I want to do next is pull up some of the most recent news data we've been looking at. Now, if you haven't joined our Telegram chats, I definitely recommend you do, especially if you like to do a lot of research. And so I post all the stuff I'm looking at, which is a mix of reading all of Bloomberg's newsletters and content, looking at the futures market at night, paying attention to important Chinese media outlets, trying to get their reaction to how they're going to respond to this tariff and Huawei dispute. And then we also look at some data from Seeking Alpha. Really look for reports that are kind of slipped through from Zero Hedge from the major banks. And also we subscribe to several YouTube channels, and I pick out the most important content. So who's getting rich on this equity rally? Not a lot of people. It's mostly been spurred by stock buybacks, and now we're at another record-breaking year for stock buybacks. That's one of the key reasons our diamond and whale portfolio is such a smart way to set up your portfolio, because these are the companies that have the greatest profits, they have the greatest budgets for stock buybacks, they have the best credit rating, so they can borrow the most money at the smallest rate. And also, they are the place that all these big ETFs automatically flow their funds. So there's a good demand for these products and a great options market. And so the SPY is flying up. Option market is betting on the 290 price. The long view is a good feed on Twitter. This guy used to work at Bridgewater, the largest hedge fund in the world, ran by Ray Dalio. He's always pointing out interesting stuff. So we have Iranian fuel oil at China port, which was supposed to be banned. Lance Roberts is a prominent figure on Twitter and a lot of news outlets. Of course, he's a big bear, so I do always take all of his info in with a grain of rice. But this is something that's worth pointing out. We're averaging about a crash every 15 years over the past century, and these crashes have been as low as 46% and as high as 80%. And so if we lose half our portfolio, we have to then get 100% gain to make it back up. And so the name of the game with our product is to try to avoid losses at all costs. We don't mind this fear of missing out feeling when we know that we're protected to the downside at all times. So that's important to remember. Another thing is looking at some of these periods where if you were buying into a bull market thinking it would go up forever, oftentimes that didn't work out so well. And so we can look most closely at the 60s, where the market went up for a few more years, got volatile, and you ended up waiting 23 years to get back to even from 1965 to 1990. And a lot of these big moves up were very quick. So there's really, if you look at this, a lot more time going nowhere or down versus up. And so if you have a strategy that's buy and hold, you better have a long time horizon. Otherwise, you might get caught in one of these flat or down markets. Now, with our strategy, that's what we're preparing for. We're preparing for downside. We don't want to lose money. We want to let the gamblers bet the market will keep going up. And so the 60s through the 70s was the Cold War. It's also where the government started spending a lot of money trying to decrease the inequality of the rich and the poor. We ended up with hyperinflation. We ended up with rates skyrocketing. And so interesting to see the parallels of today now that we're heating up trade wars with China. Meanwhile, China has some data coming out recently. They've been increasing their credit substantially. Something like 5% of their monetary supply was added just this year, which is a huge amount of money as their debt levels continue to rocket higher. But they're trying to support their real estate market, which is showing signs of that. A good company to look at is Tencent. They're still growing. So if things like that were to start to deteriorate, that would be a better sign that maybe the trade war is getting to be enough pain for China to actually make some changes. But that's not what's happening. We are actually escalating this. And so President Trump fired another shot in the trade war yesterday evening, signing an order that's set to restrict Huawei and other tech firms from supplying 5G networks in America. And also, we're now blocking the locations that they buy parts to build their products. So another tweet, Telegram's actually down, so some of my most recent posts have not popped up on here yet, but a little report came out that they'd actually stockpiled 12 months of parts, predicting that all of this would happen. And so it's actually a bigger deal, even though the Americas are a small part of their sales. Blocking these affiliates is definitely escalating this. And we're seeing a general flood of capital from foreign investment back to local investment around the world. And so we've can look at this with $1 billion in outflows in emerging markets, and the Chinese equities have seen outflows of 2.5 billion, but the same thing's happening to American markets, as we'll see in a few moments. Meanwhile, we do have Huawei's daughter being held trial for some crimes, as well as two of the Canadians now facing a death penalty in China. So this is a big thing that's escalating. And it looks like the Chinese were just kind of nodding their heads, telling us whatever they wanted to hear for about 2 years now, right at the point where everything was ready to rocket higher, and then they pulled the just kidding card. And the more I look into this, it does not look like China has any reason to make any amendments right now until a lot more pain has been put into the markets. Oil continues to climb. Gold is continuing to climb, not nearly as much as Bitcoin, but it's a much larger market cap. Lumber is still at relatively low prices, back towards the 2014 levels. The bond market is just absolutely crazy. Negative yields all over the world. If we go to the Hong Kong, it's 1.6. Go to 30-year, it's only 2.8 in America. So that barely covers inflation. So this is definitely signaling some trouble around the world as these rates continue to crater. And so for the whale product, that TLT is nice. Now, if you are holding Bitcoin, this is the most interesting chart. This is the conversion of the USD to CNH. And the magic line that all the analysis likes to revolve around is breaking above 7. We're at 6.9. So As tariffs rise, they are devaluing the currency to make the products more affordable because, of course, it's the Americans, companies that have to pay the tariffs. And so to offset that, if the conversion rate is higher, that helps reduce this pain. But if you're Chinese and you're rich, now your value of your currency is quickly depreciating. So this was happening also in Turkey. So we have had two big catalysts to make rich people want to flee their own currency. And I believe that is the biggest fundamental reason why the Bitcoin rally has been going on. So as soon as we hit the 7 on this, that would probably be a good indicator to start taking some profits on the Bitcoin. And then shortly after that, I'll be looking to actually short it. So we'll keep a close eye on that. Bitcoin is at $8,200 last night. It's trading a little bit lower this morning. And so we'll keep close eye on that. Now we're recommending a total portfolio allocation all the way back since 2017 of no more than 5% of your total portfolio. And after talking to people, I know that's not what a lot of people do. They chase whatever's hot and go all in, get that instant gratification, and then suddenly it crashes and they sell for a loss. So if you use this as more of a hedge and a way to get some extra return in your portfolio, it makes a lot more sense. So this is now up considerably in our model portfolio. So we'll definitely be looking at when to go to half cash, then to full cash, and then into a short Bitcoin position. So we'll show you how to do that very easily. But I don't think we're there yet. There's probably at least a few more months of these tensions rising between China and US, if not much longer than that. This Hu Jing seems to be the spokesperson on Twitter for the Chinese that gets retweeted a lot. Most Chinese agree that the US is more powerful than China and Washington holds initiative in the trade war, but we just don't want to cave in, and we believe there's no way the US can crush China. We are willing to bear some pain to give the US a lesson. So that seems to be the case. They are not going to just bend over and do what we're asking them to do. Bank of America increases minimum wage to $17. This is important because as this becomes a trend, it started off with Amazon, now we're getting Bank of America. As the minimum wage goes up, this will put pressure on profit margins and also on inflation. So these are all negatives for the stock market in the long run, and something we're carefully keeping track of. Chinese were outraged by a Bloomberg interview with Steve Bannon, basically screaming, let's go to war with China. They're stealing all our stuff. But meanwhile, all the economic data stateside is still strong. Nobody's freaking out yet. And there's still the hope that the two parties will come to an agreement soon. Here's some data showing the treasuries held by the Chinese, which has dropped by about $100 billion in the last 6 months. But they're still holding on to 1.1 trillion. And so some of the rumors floating around that they might dump their treasury holdings. However, they have to buy a lot of oil. They're the world's biggest importer of oil, and everybody wants to get paid in dollars. So I find that unlikely. And we're seeing this actually all over the place. Everybody is just nationalizing. They're bringing all their money home and investing in what they feel safe with. And so we can see it's happening with foreign stocks, foreign bonds. It's really just the corporations buying back their own stocks and the Bank of Japan. And while America is still showing signs of strength with its corporate earnings, with its 3.2 GDP, the global trade is cratering back towards the 2008 level. So unless this really has a sharp turnaround, I expect things to get far worse. So here's some of the tweets from yesterday, and that wraps up the items I had saved in this chat. Now looking further down the road, this is some of the intraday content we published to our whale group Telegram chat. And if you're a fan of Jeffrey Gundlach, he's big on the rising rates scenario. And it's just, according to the U.S. Treasury Department's Office of Debt Management, the U.S. government in just 5 years will be at the point of no return, when every single dollar the government borrows will go toward funding interest payments on the national debt. And so Jeffrey Gundlach points out that while we have a nice GDP here in the States side, it was done while accumulating a massive amount of debt. And so it's not like we've become a rich company with saving, or a rich country with savings. It's more like we've just continued to max out our lines of credit and went on spending sprees. So is that really healthy in the long term? Probably not. This was a piece from Bloomberg about what might cause the Chinese to dump treasuries and if that would cause a rate spike. And in this piece, he's arguing that they would, if they did do that, that would be a sign that the trade war was really escalating and that there would be a huge global slowdown and push yields even lower as a safe haven asset. So for our whale program, we can see pretty far into the future that the TLT looks like the safest place to be, and then to sell that covered call against it. This is a little data on some of the times that the yield curve has inverted. And so a lot of people think that's a guaranteed crash when that happens. But the problem is that usually happens about 18 months after it inverts. So here's a chart showing some of the times that the yield curve has inverted. And then the gray part marks the recession. Also in the news is that Amazon had a $900 million purchase from Berkshire. And what's interesting, Amazon's making a big push towards same-day delivery, and they're now giving a $10,000 subsidy to their Amazon partners to start up their own delivery companies. And so they continue to push the envelope on creating the best place to shop online. And if you thought, one-day delivery was great, now they're pushing towards same-day delivery. Imagine the pressure this will put on your retail stores. So Amazon continues to grow rapidly, and now it has Buffett on its side. So hopefully we'll get the chance to pick up that in our whale club at a discount. So we're waiting patiently and holding onto our bond portfolio in the meanwhile. In the diamond portfolio, the biggest run-up was in Cisco, and we were a little more bullish on that covered call on that, so we caught some of that profit. But again, this is the strategy where if the market goes down or sideways, we really shine. We make our same boring return. When the market flies higher like this, you have that feeling of missing out. But we don't lose. We're in a situation where we make money with a super high probability and a lot of protection. All right, let me go back to our basic portfolio. So now let's open it up for some questions. Okay, I got a quick question from Jerry. So Telegram seems to be down, but I don't think you're in the right chat. So I'll make sure you get added to it. But every update has a link to these various chats that you're subscribed to, so you can get them, and that's where I'll post all the intraday content. But right now, Telegram's not updating. I've posted like 10 new articles that are still pending to publish. Okay, I got a great question from Fred, and please everybody, don't feel shy. There are no stupid questions. If you're thinking it, probably someone else is thinking it, and they're just too shy to ask it. Okay, so Fred wants to know why it's smarter to do the covered call strategy rather than sell secured puts. And that's a great question. So when the market's going up, both strategies perform relatively similar. Okay, so if I sell, let's just look at a potential trade. So the opposite of our strategy that would appear to be very similar would be basically something of this nature. So let's just look at a trade we could potentially do between now and tomorrow. So if I wanted to sell to open the May 17, 2019 287 put, I could collect that same 59 cents. I mean, we're making about 67 cents, $69 per share from Wednesday to Friday. And that's just about guaranteed at this point because the SPY has gone up so far. And so we could make a very similar profit doing almost the same thing by just purchasing the put. So what's the difference? Well, the problem with both strategies that we need to look out for is when the market starts to head down. And so the big fear with selling to open the put is that if the SPY were to crater, and what could cause that? Oh, I don't know, maybe a Trump tweet. You know, wait till he says he's raising the tariffs on the remaining $300 billion of goods. That's coming. And so what happens when that occurs? What happens when the market is violently pulling back? Well, the value of the put option is going to become very expensive. So all of a sudden, you're going to be in a position where you have to own the SPY shares and you're going to get assigned overnight. And the American political people have been basically trying to pump up the market during the day and then release bad news after hours. So you're going to end up in a situation where you are going to be holding a short put option contract, potentially get assigned in the last hours of the day or overnight, and then you're going to be sitting on a SPY position that has had a huge loss that you're going to have to liquidate the next morning. So it's similar, but the outcome of being assigned when we sell to open the put is that we're going to have this window where we're not sure if we're going to be assigned until the next morning. We're going to have to check our account, and sure enough, we're holding on to the SPY. Now we've lost a few dollars per share. Okay, so now you can get out of it and go write your new put option much lower. But at the end of the day, you're going to be the one who ends up holding the bag. And when you're wrong, when the worst case outcome happens from the person you sold that put option to, you're going to have to purchase the SPY shares for a big loss. When we do the opposite trade, we're never in that situation. So if I sell the 287 call option and the SPY starts to drop, at any point in time, I can buy back that call option for a profit, and I can immediately write a new one at a lower price. Okay, so if the SPY starts to go down, I can buy back my call option for a big profit and write a new one and protect myself further and further and further down. So if I sell a put option, that's just not the opportunity. Now, if the worst case outcome occurs when I sell a call option, I end up in cash. I agree to sell my shares at some price, and the call option buyer gets to take that profit. So in one case, we have complete control of the assets at all time. And if we're wrong and the market flies higher, the person we sold that call option to takes advantage of it. It's a fear of missing out. and they get the big profit. We get whatever spread we had baked into the trade, and we're sitting in cash. Cash is not going to go up or down in value very rapidly, while the SPY could in a panic. And so that's just the difference. Now, can you cover a short put option later for a loss before you get assigned? Sure. It's just a much more advanced strategy. You're going to have to be willing to hop onto that trading desk every morning at 7:30 and hope nothing disastrous has happened. And it's just a totally different strategy. So for us, it makes more sense to own the asset, sell the in the money covered call, and really be able to get out of it much quicker. So, okay, great. I'm glad that. Does anybody have any other questions about how the difference between the covered call and then selling the put? So they're very similar. It's just one is a lot more hands-free, while the other is, you're going to have to be really willing to wake up right at 9:30 Eastern and make sure nothing disastrous has happened. Any other questions out there? Looks like we got a pretty quiet group today. Well, I'll just do a quick wrap up of what's going on in all our portfolios and let everybody get on with their day. So in the basic program, the last trade was the 280 strike for a credit of 467 with a spread. The difference between the loss on the SPY and the credit we took in was about $69, which doesn't sound like a lot, but if we can safely do that 3 times a week, that is close to a 35% return without compounding profits, just from the covered call. And so we don't normally want to write the in the money covered call, only when there is a real risk and threat in the market, which there clearly is right now. And so while we have the automated traders shorting the VIX and pushing it back towards new highs, this allows us to still write our in the money covered call, not be greedy, not worry about missing out on big profits, and continue the game of essentially being a landlord. We own one of the most popular properties in the world, the SPY. In fact, it is the most popular security in the world. And there's plenty of people who want to gamble how high it will go up in 48-hour chunks. So we can do this for the rest of our lives, generate income, and be able to sleep like a baby at night and not worry so much about what happens with Trump's Twitter account or with the Chinese getting ready to stab us in the back. So that's the name of the game with this portfolio. It's been working like gangbusters. We've been pulling profits out of the market when it's flying down. We've been pulling profits out of the market when it's flying up. And we've been pulling profits out of the market when it goes sideways. So missed out on some of the gains today, but it's not a big deal. We hit the maximum gain on our trades. And I think we've only had 2 time periods where we actually lost money in this portfolio. And that only happens when the SPY drops below our strike. And that usually is very hard because I'm super paranoid and more often than not have been wrong on the side of precaution. So the 2 times we have lost money, the market fell about 5% and our portfolio lost a percentage point. But I said, watch, we're going to make those profits back up within a few weeks. We did it within 3 trades. And that's because as the volatility spiked, the option premium we were generating actually increased by a multiple of 4 times. So instead of pulling in $25 to $50, we've been making anywhere from $75 to $125 per contract. And instead of having to write it out of the money to get that type of return. We've been able to do it with safety in the money. So that's just incredible. Tomorrow we will be replacing this complex cryptocurrency technology with the simplified version. And so you will get a new spreadsheet and a new tutorial so that you can follow along. And we're tracking the devaluation of the Turkish lira and the Chinese currency to try to predict a top in the cryptocurrency market. So right now it looks like there's plenty of room to go from here, but at some point we will recommend first selling half your position into cash, then we'll go to completely cash, and then eventually with a small part of this portfolio, short Bitcoin back down. And again, this is only recommending 5% of your total portfolio hold cryptocurrencies. They are super volatile. They can crash 90%, they can go up 1,000%. That's their risk profile. So it's not something you should be all in with. And so look forward to that coming out tomorrow. Our diamond portfolio will make its next trade on Tuesday. We will cover these positions and write a new one. Most likely another in the money covered call, predicting some potential volatility and risks ahead. So we'll set ourselves up to have downside protection. But if we're wrong and the market goes higher, we'll have a baked into the cake profit. This portfolio has been performing at twice the rate as our basic portfolio, trading only once a week on Tuesdays. And that's because there's more volatility in the underlying securities versus the SPY. So the call options cost a lot more. The speculators have to pay us about twice as much to bet on the movement of these stocks. And that's why it works out so well for us. And the diamond, the whale program is just sitting patiently on the treasuries with TLT, writing the out of the money covered call at this point. So I am expecting that this will travel higher. Now, if there is resolution in the trade war, I would expect the opposite. So I would expect for the TLT to have a pretty strong pullback if the coast becomes clear with China. So if that were to happen, we would bypass waiting for a crash and jump into the Microsoft, Apple, Amazon, Google, Facebook. But until that does happen, while we know there is definite risk of a major volatility event, we can just sit on the treasuries, write that out of the money covered call. The call option, speculators are betting that the Fed will drop rates dramatically, which would push the TLT much higher. And so that makes a great way for us to beat the returns of the bond market. So rather than pulling in 2.5%, which will barely beat inflation, we're already up to 7.2% from writing the boring covered call. And we've actually missed out on a lot of profits on the TLT because of that, as the option market has been correct. And so it's a boring system that we repeat every Thursday. This one's much more patient, and we'll wait for the right time to strike equities. And the big picture is if trade war escalates, we're looking for a safe haven rush into the TLT, followed by a pullback in equities. At that point, we would rotate into the equities and eventually rising rates. So we're looking months and years down the road in terms of this playbook. Could be months, maybe even years of holding this TLT position while the China-US Cold War escalates, eventually causing a stock crash, which again always takes longer than everyone expects and then happens so much faster than everyone thought possible. So once we do see a VIX spike into the 40 range, that's when I would feel confident to jump into this and start selling those in the money covered calls. And then as the world starts to realize the debt piling up with the slowed global growth will cause rising rates. So then we'd rotate into the TBT. So that's kind of the big picture. Of course, things change based on what's happening with mainly the two superpowers of the world. And that's what we're keeping a look at. Meanwhile, the dollar continues to dominate, and Kospi is a good leading indicator for the stock market. Of course, it is pointing down. So very skeptical of this stock market rally, and we'll continue to have our in the money covered calls to protect us until the coast is clear. Hey, Richard, welcome. No worries. Richard's one of our old school crypto guys, and so the replay will come out, Richard, in a little bit. But little note for you, I know you've been following a lot of the products, but let me show you the new crypto portfolio, which we've simplified. So we are going to be issuing an alert to all our old crypto people to take profits on all those altcoins and to make your portfolio much easier to manage and maintain, and also to have a federally in portfolio. So we'll so the way will be to the altcoin, enjoy the profits that we ran up on that. Simplify your portfolio. We're 50% Bitcoin, 29% Ethereum, 12 Litecoin, 7 Bitcoin Cash. We're carefully monitoring the devaluation of the Chinese currency and the basically the blow up of the Turkish lira, which I believe is the primary drivers forcing the rich to go load up on cryptocurrencies. And so as long as this trade war is escalating, as tariffs are rising, the Chinese will most likely continue to devalue their currency to make imports cheaper, to make it affordable for the Americans to buy their products and still pay the taxes as they come in. So I think we do have some room to run on this, and our move will be to first sell half the portfolio into cash, let it ride a little higher until we think we've absolutely got to an insane level, like we did back in 2017, and then go all cash and venture into a small short Bitcoin position, which can be fun but dangerous. So we'll be doing that with a small part of the portfolio. And again, the cryptos should be no more than 5% of your total portfolio. It does provide a nice hedge outside of the put option we have on the SPY. But really, if you follow my products, I'd much rather make a boring, safe return 3 times a week than take on big risks and worry about missing out on things. Any other questions out there? All right, gentlemen. Well, tomorrow we will release the updated Portfolio Builder 2.0 spreadsheet, which has the cryptocurrency tab that's super simplified, easy to follow, plus a new tutorial video teaching you how to use the spreadsheet. These products are designed to not require the spreadsheet so that you can just do it in your head. But if you do like to manage it with the spreadsheet, this sure is a nice tool to keep track of what you're doing and when you're doing it. You're welcome, Richard, and I will definitely get that recording out to everybody right after we get this closed up. So look for a new trade alert tomorrow on the basic program. Will be likely assigned for a lot of you and back into cash on the SPY. So you'll have that max profit realized, and then we'll be ready to buy back the SPY and sell that covered call immediately. So thank you everyone for your time, and looking forward to a new trade alert tomorrow.